electric two-wheeler has around 40% market share. Other than that, the benefits that BofA is highlighting that the company has been focusing a lot more in terms of expansion of its product profile, as well as in terms of they found the key pieces where there's a gap between in the EV puzzle. So that's what they want to focus on, and forecasting around an 18% penetration rate by FY25 for electric two-wheeler. That's going to be interesting to watch out for, and 25% by FY30. Moving on to Goldman Sachs report, they too buy call target price of 160 rupees per share. They believe that the company is structured quite well for long-term synergies from the electric two-wheeler market, because that's seeing a good improvement and a good trend in the Indian market. So domestic is something that will work out well in terms for Ola Electric. Other than that, overall, they're expecting a revenue growth of around 30% over the next 5 years for the company, and they are implying a free cash flow break-even at around in FY30 for the company. Valuations also versus Tesla, which is a global player, is at around similar levels, while with two-wheeler players, it's much lesser, so keeping an eye on that.
All right, Ola Electric in the pre-open is indicating a 5% higher start. Vinny, thanks very much for that. But there is, of course, Ola and all the other names that we highlighted with our research team earlier as well. So just market open first rates. So we'll do the indices and go into stocks. So 25,394, 395 is where the Nifty is starting, which is almost unchanged. Sensex is, actually, blinking fifth between green and red. So 83,000, 82,998. So that kind of open. We've got nothing on the Nifty Bank as well. 45 points, so 0.09%, 52,200 on the Nifty Bank. So very, very quiet. We've got the IT index, which is coming up with about a 0.25% cut. So 43,254 is where we are at. Market breadth is positive. So almost some 3:1 in favor of advances, but it's kind of early. The heat map on the Nifty in terms of number of stocks which are opening up and opening down, it's actually almost evenly balanced. So I think about 20 names should be down and maybe a little bit more earlier. And about 30 of them are opening in the green. So that's the Nifty heat map. So 2-point grand change on the Nifty within the first minute of market open.
Okay, well, let's look at some stocks which are active. Look at Bajaj Housing Finance on the go once again. There's a 9% pop on that stock. If I remember correctly, it's Phillip Capital. They've issued a positive note, and their target price is northwards of 200 on that stock. And it's inching towards that mark. 9%. That's a big move on Bajaj Housing. Ola Electric, the stock which is discussing, up about 4%. And the gas companies, city gas companies, IGL and MGL, reacting really well to some of the brokerage notes that have come in, which are quite favorable. Anyway, on the Nifty, it's very quiet, just about 7 points lower now. It's a flip-flop on the FMCG space. One day up, one day down. Today's one day up. Tata Consumer, Britannia, Lever, these are some of the stocks on the upside. There's a little bit of buying on some of the other heavyweights like an Axis Bank. ICICI Bank and HDFC Bank are sitting on the fence. There's no clear move as yet on the banking pack. The Nifty Bank is also fairly flat at this point in time. Hindalco is managing some green. But let's look at the red side of the screen as well. Profit taking on Tata Motors continues, 2.5% down on that stock. Wipro, Maruti, these are other names on the way down. SBI and TCS are two heavyweights, counted in Infosys as well. So some of the IT big boys starting lower, along with the State Bank of India. Basically, it's a net neutral on the Nifty with a downside bias, 15 points lower.
Downside bias indeed, and you can see that increasing number of stocks declining in the broader markets as well. When we started, we had about 300 stocks declining. Now that number has quickly doubled to around 1,000, tripled, doubled to 600, and now as we speak, the advanced decline lines are split right down the middle. Equal number of stocks advancing and declining. Bajaj Housing Finance has now hit that 10% temporary freeze, so we'll keep an eye out on that one as well. Interestingly, a lot on the street were hoping for some sort of valuation catch-up in other housing finance companies too. That hasn't happened. It looks like there is still some soft moves that we're seeing on names like PNB Housing Finance. LIC Housing Finance has entered F&O ban, so we'll keep an eye out on that one too. Global Spirits, the street likes their entering the luxury segment with a new craft whiskey. Craft whiskey made by India is something that has been a big mega trend, and that's led to a big move in a lot of these alcohol stocks in India itself, Radico, Khaitan, Piccadilly Agro, etc. And as a result of which, Global Spirits being rewarded for the same. On the way down, we have a bunch of stocks which are actually lower. Tirupati Balaji Agro, another recent listing, has been down 5%. TBZ, all the local jewelry companies seeing some bit of profit taking. So TBZ is down 5%, a lower circuit after a big move this month itself, up 54% this month, including the 5% cut that we're seeing today. Godfrey Phillips seeing some bit of profit taking as well. On the way up, of course, you did point out the city gas distribution companies. They've extended their gains. IGL is up around 5.5% right now. MGL up around 4%. Gujarat Gas seeing some traction as well, though not strictly a city gas distribution company. First Source is the other one. Opened with a gain, holding with a gain, but still off high. So about 2% up move is what we're seeing on the partnership that they've announced with OpenAI, the contours of which we still do not know.
Absolutely. That explains the move in Tata Motors. It is the weakest stock on the Nifty right now. There is a large block, 0.4% equity moving around. And the sector of the morning, shouldn't actually say morning, but you pointed this out, Mangalam. So Alcobev, it's not only Globus. Piccadilly itself is up 5%. Radico is still continuing its move from yesterday, up about 1.5%. A little small tinge of green on United Spirits as well. So these are some stocks on the way up. But otherwise, Prashant, very quiet on the market. Even the mid-cap index right now, absolutely unchanged.
Quiet in markets and noise in the streets.
Yeah.
So yeah, absolutely. It's not very much going on, at least at the index level. Maybe a few other names and we'll bring in our guest. So I'll start with what else is happening. Actually, market breadth has moved to being almost exactly equal, 1:1, with about 5 minutes of market open behind us now. Bajaj Housing is limit up 10%. 181 on Bajaj Housing Finance. Ola is close behind with a 4% pop, but large volumes in it. I think IGL, MGL, First Source, all these we mentioned. We've got, Aarti surfactants, 8.5%, 832 or so. That's a big move on Aarti coming through, and backed by volumes as well. There is Ecos Mobility, which is showing up with a 2% gain. Kohinoor Foods is up 10%, 11%, 52 on Kohinoor Foods. Panacea Biotech is up about 5%. So it goes. I mean, essentially, a few of these names. India Shelter is up about 1%. Remember, yesterday, PNB Housing, LIC Housing, India Shelter, all of these, and there was a very large block which happened yesterday on India Shelter as well. So all of them sold off very aggressively. They are down about 7-8%, and we'll have them up as well. On the downside, there's Godfrey Phillips, which is down 5%. It's the second largest volume-led loser on the NSE. And of course, Edelweiss, which has had a one-way move, is pulling back about just 1%, nothing, 128, 129 on Edelweiss. TBZ, Tribhuvan Zaveri, which has had a rocket like a move, 4.5% lower. So these are just pullbacks. Lodha is down about 2.33%. Tollens, which is basically the tire maker from the listing from yesterday, that is down about 4%. It's had a pretty subdued flat listing yesterday, and this is day 2. Root Mobile, Triveni Turbine are some of the other names which are coming up with some rates, but not very much really in terms of price action. Quieter. Karthik Kumar is fund manager at Axis Mutual Fund, is with us to sort of take some questions. Karthik, great to have you with us here. Thanks for your time. The big debate, of course, is how does one sort of navigate the start of the easing cycle and the easing cycle itself, because it's going to be Fed and then maybe others will follow. Not exactly synchronized, but that's the general expectation into the end of the year. Some, depending on who you ask, between 75 to 125 basis points worth of rate cuts. So at Axis and you and your team, how are you sort of viewing this and implications for markets here in India?
I think with rate cuts, obviously, we're already seeing sector rotation on a much more frequent basis than we did see before. Part of it, I guess, we could attribute it to uncertainty coming from macroeconomic policies in the West. But at the end of the day, we are, as a house, we are much more focused on ideas and on looking at themes here that are much more specific and positioned accordingly. But what you're seeing in the markets is essentially over the last couple of months is it's been consistent in the sense that the breadth of the market, or rather the spread, like the case today, where the outperformance of mid cap and small cap to large caps have narrowed compared to what it was the case, what was the case previously, and also sector leaderships and from strictly speaking from a quantitative framework, style leaderships have also evolved over the last 3 months. So we are positioned accordingly to that, and more from a bottom-up perspective and less so from a top-down angle.
Okay. Yeah, so sector rotation and some change in leadership. That's we're beginning to see some signs of that, Karthik. Good to have you on the show, by the way. Good morning. So to be here. So, the basic question that came to mind yesterday after looking at the Bajaj Housing Finance listing is, is the market still willing to pay top dollar and digest those kind of levels for stocks where there could be promise? What is your sense? I mean, for a housing finance franchise, would you be willing to pay, 6 times, 7 times? Are we back in that zone?
It seems like, based on what the data we've anecdotally seen, we are back in that zone. But essentially, if you look at what's been working over the last 2 or 3 months, as you rightly pointed out, we are seeing sector rotation. And the other thing we are seeing is a switch back to quality, where the market's focusing back on some of these low beta names as a theme, or even looking back at stocks and sectors where your ROEs are structurally much better. And so the focus has come back to a bit more quality over the last 2 to 3 months, whereas your styles that were leading previously, which was growth and valuations, have kind of taken a backseat for now. And that is evident even when you look at it from a sector perspective, where be it FMCG or pharma or IT, those sectors have kind of done well over the last 3-4 months, whereas the leaders from the prior 3 months or 6 months have kind of taken a halt here.
Well, you spoke about quality, and we are seeing a bunch of stocks doing well, as the hotboard on the screen also suggests. Yeah, the only sector which is seeing the most amount of gains right now is FMCG. Was under pressure in yesterday's trading session, routine profit taking, one may say. I just wanted your thoughts on this quality versus all the others battle itself in the market right now. Because while quality did not see a multiple re-rating, it was already at premium valuations, the others started to rally. And as a result of which, that valuation differential got narrowed. To that extent, does it make quality attractive largely from a valuation standpoint, or more is it more of capital protection that you're looking at, given the sort of, up move that we've seen in a lot of places?
I mean, you're absolutely spot on in the sense that quality was expensive a couple of years ago. Just to put this in context, quality has had a rough ride for almost year and a half now. So to that extent, the other styles or the other areas of the market have caught up in terms of valuation. And quality, given its nature, will always trade at, I would argue, would always trade at a premium to general markets. So the larger theme in the market has also been catch-up, whether be it at a stock level, sector level, or at a style level. So you could attribute it to focus on capital, or you could attribute it to general nature of the markets to focus on areas of the market that have kind of lagged the headline numbers, and so which is where the focus has come back to quality. And the fact that the valuation spreads have narrowed has kind of helps reinforce that case. But as I said, the quality as a basket would always trade at a premium to markets, in my opinion. That is unlikely to change. So
what are your top sector picks right now?
Right now, I'm bullish consumer staples. I'm overweight healthcare and discretionary. Whereas I continue to remain underweight energy, commodity plays, and IT.
All right. Karthik, on IT, would the view change a little bit at the margin at all because of the rate cycle? Most IT companies, when we speak to them post-results, not actually most, but many, and I'm talking about larger ones, they do flag off this higher rates in the US as a bit of a problem. To be able to tap into new business, and how so I'm assuming that if the rates start to come off, I mean, business should at least the margin incrementally pick up. Wouldn't that reflect for you as an investor as well?
So on the margins, I've kind of reduced my underweight positioning in IT. But having said that, if you look at the earnings profile or the expected growth rate over the last 2 years, or over the next 2 years, I mean, the fact that we are going to be in an interest rate cut cycle is a certainty. It's just the timing and the pace at which we are going to go through it remains is debated. But the event itself is kind of all but confirmed, right? So to that extent, despite that, what we are not seeing is a broad-based improvement in earnings indicators so far across IT. Selectively, you do see it in stocks, but not across sectors in a broad-based way. Which is why, while I've reduced my on the margins, I've reduced my underweight to IT, but that is more coming from stock-specific picks rather than a sector-based call.
In terms of just market, again, this is because rates are starting to come off. What does it mean for smaller businesses? Do smaller rates mean at the margin are much more positive for smaller businesses to be able to access funds? And I mean, it means a lot more, right? Larger entities can access funds anywhere. So for the small and mid-cap universe, as we go into the next, say, 6 months, 8 months, what does this mean?
I think it also depends on under what economic context are we talking about in terms of the rates coming down. If it's a soft landing, then it could mean all that you said for all things positive for mid caps and small caps. But if we get into a kind of an if we have economic headwinds and the interest rate cuts are happening in that scenario, then one could argue, at least from a portfolio positioning and from a stock positioning, probably large caps would be a better place to look at rather than mid caps and small caps. So instead of looking at just, I would prefer, instead of looking at just interest rates in a silo, we also look at in what context are we talking about, and are we talking about a soft landing, or are we talking about something slightly more negative than that?
All right, take your point. Thank you so much for stopping by and giving us your sectoral calls, your view on the market on the whole. Positive on consumers, staples, prefer large caps over mid caps and small caps. We keep an eye out on that. In fact, the next discussion that we've lined up would be a theme of your interest itself. It's got to do with the consumer staples, and all of them actually doing well. We have Britannia, HUL, Tata Consumer among the top Nifty gainers right now. The other one that we're talking about is Patanjali Foods, in focus as the government has increased basic import duty on edible oils by 20%. A sentiment negative for the sector, but is it really so? We have Sanjeev Asthana, CEO of Patanjali Foods, with us in the studio. Thank you, Sanjeev, for joining us in the studio. We've been talking distantly for a while right now, but this is a topic that needs to be addressed, right? 20% increase in import duty for refined oils and refined edible oils, etc. Just your thoughts on, one, after this increase, what does it take your basic procurement price to, and would that have any impact on margins? Would you be able to pass it on?
No, so there are two parts. One is that this was a very critical requirement which the government has fulfilled. Two bits which were impacting it. One was that the oilseed prices were running way below the minimum support price declared by the government. And this was causing enormous amount of stress to the farmers of soybeans and mustard. So government had to do. And second is the differential between the crude oil and the refined oil was very minimal, which was hurting the industry as well. So in terms of the step taken by the government is very timely, and I think it's a very welcome step for the industry. The issue which still needs to be resolved is the differential between the crude oil prices and the refined oil prices, which is basically supporting the overseas refiners, which can continue to sort of find homes into India. And Indian refineries will have to struggle to really make the margins meet. So there's a one-time inventory gain, which will be offset by part of the gains because the advanced sales what have been done. You have to buy a higher sort of priced oil.
So what happens to players like you? Because you are, I presume, importing a lot of these as well. With the import duty having increased 20%, does your cost of procurement of these products increases, and could we see an impact on your margins?
No, it does. I think there are two sides. So one is, as I mentioned, there's a one-time sort of, some value, on the profitability which will increase. The larger issue here is that, for the sector itself is positive. For the oilseeds as a sector, which is going to be on the growth path, this is positive. And the third piece is that, calibrating the prices to reach the levels at what's internationally are required. So that's very important. So I would say that overall a very positive step.
Just another word on the oil import duty and the impact. I remember earlier conversations a couple of months back where you yourself are getting into palm oil cultivation in a very big way, right? So what is the target? I mean, how much would you want it to be captive? What is it right now? And what are the timelines on that whole project?
No, so currently we have got about 75,000 hectares which is under cultivation, of which nearly 70% is already yielding. So we make a serious amount of money. It's almost an assured EBITDA margin of between 16 and 18% that we get. We are targeting 500,000 hectares over 5 years. The target geographies being south of India, Andhra, Telangana, Karnataka, and the northeastern part of the country. So it's a large project, very positive in terms of the future sort of EBITDA addition that we can make to the business. And it's almost like an annuity gains that we'll be able to do that.
And how much of your own demand or requirement is being met through your own cultivation?
So today we do about 10% of what we do. So we produce about 110,000 tons of crude palm oil from that. This, in fullness of time, when we do entire 500,000 hectares, will go to close to about 500,000 hectares, 500,000 tons. And this will be about 60% of what we'll require, because by that time our imports will also continue to increase. So very positive, as a project that we're taking, and of course very helpful for the country as well, in terms of reducing the dependency on imports.
So with all things being positive, the question that one begets asking is, why is it that the promoters sold about 3% stake in the company a couple of days ago? GQG bought that stake. They already held about 3% stake. So what's the plan with GQG? Are they looking to buy more stake? And the promoter stake selling?
So I think there are two sides. One is that the global investors have reposed a lot of faith. And this validation of, what we just did, a block deal, the promoters did, it is very positive in terms of the global marquee investors have tended to repose a lot of faith in the Indian consumer story, Patanjali in particular. So that's something that we feel very happy about. Longer term plan is that, we will continue to sort of build a stronger sort of platform. Integration of HPC business shouldn't take too much of time. I think we're just waiting final regulatory approval. This should happen pretty much within this month. And from the next quarter, we'll start inducting the HPC business into the fold of the company. So very positive for the company, good for the promoters, and I would imagine very good for the sector as well. That's a lot more.
Will they sell more?
Yeah, you didn't answer the question.
I don't
if you had any conversation on why they sold, I mean, it's 2.7%, not too much stake sale. I guess even after the stake sale, the level is 70% promoter holding. But was there any conversation?
No, of course. There's I think largely the very clear cut that promoters have largely divested all their profit-making businesses into this entity, the listed entity.
Got it.
They need to clear their own debts, and it's a very logical way. So, the source of income to pay off the debt, I think this is one way to do that.
What is the debt on their books right now, and does it get cleared with this 3% stake sale?
So most of it will get cleared. There's a partial sort of debt which will remain. That will continue that. So there are no timelines. There's no plan to kind of divest any further equity.
Mr. Asthana, would you look at demerging? When will you look at demerging the oil and the non-oil businesses within the fold, your fold?
So this question gets asked very frequently. So our plan is not to demerge at all. So these are very good businesses. So for example, palm oil is vertically integrated, which integrates itself into the branded side of the business. So there's no such sort of plan on the cards right now. And we will build up a strong company, which is diversified.
Bankers have come to you, how it'll mean value accretion and this and I mean, all of this. The essential point is one is a very low margin business, the other is a much higher margin business, and that's where the argument stems from.
No, you're right. I think this gets discussed very often, and I think this is something that we've thought this over. And the belief is right now that demerging anything would not be a sensible step for the company to take.
That's as of now?
Not as of now, for the future as well.
So no plans at all? I mean,
none at all.
Nothing,
none at all. None at all. It's not on the table.
How's the non-oil business doing? I mean, could you give us a real sense across segments for you?
So non-oil business is very strong. Last year we did almost 10,000 crores of revenue, which is 30% of the company's overall revenue. Target is to, over next 5 years, to take it to 50-50 between the edible oils and go to the double-digit EBITDA and perhaps do better. HPC portfolio will add a lot of heft to what we offer. Yeah. And all the categories are going fairly strong. So foods, FMCG side is growing at 10%. HPC, the target is that we'll grow at 15%. The edible oil category is growing at between 3 to 4%, which is where we want it to stay as well. And so overall, we are feeling pretty positive. So on all the parameters in terms of return on equity, the overall absolute profits that we are able to generate, return for the stakeholders, the overall aggregation, it's a good story.
So tell us one thing. I mean, you did, in FY24, you did revenues of just under 32,000 crores. Margins ballpark around 5%. You're talking about all these other engines firing up, HPC, building margins over there, the plantation business being more accretive for the EBITDA. So FY25 and more importantly, says FY26, once the integration is done, what are we talking about in terms of top line growth and the lifting the margin profile itself of the listed blended entity Patanjali Foods?
Our target is to keep adding 1 percentage point to 1.5% every year, financial year, to go towards 10% double-digit EBITDA.
Got it.
So the story, the sort of the trend line that we want to make sure that we get closer to 6.5% next year and continue pushing thereafter. And we feel pretty confident with the FMCG businesses doing well. Oil from the last 5 quarters of sort of disturbed situation. Last 2 quarters, we've seen a positive sort of play. Markets have stabilized. So overall, we feel pretty confident of the projection.
So 6.5% this year, right, on the margin?
This year, we'll have a lesser sort of window available now with the HPC business coming in. So, but we'll certainly add to the EBITDA of last year, for sure.
And just a here and now question itself. You said by the end of this month, the HPC business comes in. So this year, 1,500 crore in terms of top line from that HPC business on the cards. Can one look at it? Because last year, you did close to 2,800 crore. Assuming you're doing 3,000 crores, half of the year comes in. That's not out of whack, right? That expectation?
So that should be pretty much on the cards, yeah.
And about the oil business itself, it's now on a favorable cycle for you. Last quarter, you did closer to 200 crore EBITDA. So 200 crore EBIT. 250 crore EBIT for the next few quarters, that's on the cards as well?
It should be very much feasible, yes.
All
Looks
right.
very likely.
And promoters do not pare their stake beyond that 65% mark for the near future.
69% mark.
69% mark. We get that. Thank you so much for joining us in our studio and
Thank you.
giving us an outlook on the business, the promoters' plans, and the way forward for your oil and non-oil businesses as well. A pleasure speaking with you. So that was the management of Patanjali Foods indicating that they will increase their margins by about 100 to 150 basis points annually. This year, 1,500 crore revenue from the HPC business. For the next few quarters, 250 crores in terms of operating profit coming in from their oil business as well. Promoters not looking to sell their stake beyond that 69% right now. Take a short break. On the other side, we have another conversation lined up for you. This one with the CEO of Dr. Lal PathLabs.
Welcome back. Well, it's a very, very quiet day on the street as far as the indices are concerned. Not much changing on the Nifty, the Bank Nifty, or even the mid-cap index. It's that kind of a morning, at least for now. So we've got our eye on individual companies and stocks. So let's keep it with the corporate conversations. Dr. Lal PathLabs is now in focus. The stock has gained about 30% in the calendar year so far. The company says there are no plans to take any price hikes in FY25. Revenue growth is expected to be above 10%. To talk about the business outlook and the way forward, we have Shashank Banerjee, CEO of Dr. Lal PathLabs, joining in. Mr. Banerjee, good to have you on. Thanks for being with us. First things first, want to talk about business for sure, but now this whole monkeypox threat, I mean, we keep hearing about this as well and the new guidelines that are kicking in First and foremost, I mean, is there anything that you're noticing? And I don't know if the testing is right now open to a lot of the private labs like Dr. Lal. Just tell us the latest on this.
Yeah, good morning. I think, yes, monkeypox is something which is in the news of late, and, everybody has their eyes on it. As of now, testing is restricted to government institutions only. And I think as and when, and I think the government has said also quite clearly that right now there isn't enough cases, etc., to really worry about it. But I'm sure that, if there is something like that, they would open up to private diagnostic companies later. But that is completely dependent upon how the government looks at that. So as of now, we are also, watching it on the news and keeping a track of it.
Sure, fair enough. So yeah, let's just hope the situation remains under control. Having said that, let's get back to business and what you've outlined so far for the year, this idea of about 10% growth. Tell us what is driving the business as of now, which segments, and also why only 10%? Now that we're almost done with the second quarter, do you get the confidence that growth levels could be better than this?
So, we had put a bit of context on growth for FY25 specifically. I think FY24, we ended the year at about 10.4% growth. And a part of that growth was also, driven through a price increase that we had taken in February of the year before. So close to about 3.5% of that 10.4% actually came through a price increase. So what we have stated, for the year FY25 is we want to do slightly better than what we did, 10.4%, but without having to take a price increase. And that's what, we are all working on. And that is kind of, giving the confidence back into the system that, the kind of underlying business growth can become robust. So that is really what we are trying to work on. I think what we also saw last year was that, there was this whole overhang of COVID and, non-COVID tests related to COVID. So there was quite a lot of, base fluctuations that we have seen. So I think we really need to see a few stable quarters and one maybe financial year before we can start looking at maybe, future projections beyond that level.
Okay. Mr. Banerjee, hi, good morning. Prashant here.
Good morning. Good morning, Prashant.
So, we spoke with you exactly a month ago, and at that point you said that you do better than 11% without a price increase. So we look forward to that, and maybe once this quarter is done and you've reported numbers, you'll up the guidance in that sense. Could you tell us how's SwasthFit been doing? Because that's been the big driver, bundle testing. It forms about 24% of your top line. Just give us a sense of whether momentum is strong there. What else are you doing in terms of product initiatives?
I think first things first, what we have been saying consistently is that for FY25, we will do better than what we did last year. And obviously, the target would be to see whether the financial year we can do 11%. I think that's what we would be targeting internally without having to take a price increase. So I think that's, and we were talking about the full year because, quarter on quarter, there could be variations, multiple reasons why variations happen. I think our business is best to look at the full year performance and, the growth numbers, etc., on a full year basis. So that's what we have said, and we continue to talk about that itself. That better than last year in terms of growth. Last year we did 10.4, not without having to take a price increase. I think that's what we are all aiming for. Coming to SwasthFit, last financial year SwasthFit was about 22% of our overall revenue portfolio. First quarter, we did about 25% of the portfolio revenue was the SwasthFit. So we continue to see momentum on SwasthFit, and given that we are increasing our reach further into, tier 3, tier 4 towns and other geographies also, we have still got a lot of confidence that, we'll be able to keep growing the SwasthFit portfolio, at least for the next, near future that we see.
Right. On that 11% growth guidance itself, assuming you do not take a price hike, I wanted your thoughts on how to read the volume versus realization growth here. Because on the one hand, your realizations would be propped up by some of your specialized tests. And on the other, there would be some of the offers, as you said, you're penetrating into newer areas, etc. as well, that may pressurize your realizations. So this 11% growth for this year, X of any price hikes, how should one look at in terms of volume and realizations?
So again, I think, let me reiterate, we are saying growth better than last year. Last year was 10.4, so the number starts from 10.5.
Okay.
Yeah, but we are we'll obviously be targeting somewhere around 11 if we can get there. And this is again a full year picture. So coming back to the growth mix, there are certain factors which are helping us getting a better mix. So first and foremost is SwasthFit itself. That is a higher realization, and therefore it is accretive to improving the mix. Second is specialized tests, like you pointed out, that is another part of the business. As it grows, it helps us on the revenue per patient side and a better mix. Plus, we are also seeing some benefits likely to accrue through some better geography mix, which we are also working on.
So what does that do to your margins? Because, last year you did closer to around 27, 28% margins. What's the guidance for this year?
So the guidance for this year is, margins similar to last year. And that's what we are, even last year, if you see the margins, there was a bit of a flow through because of the price increase that was taken. But we want to really look at maintaining our last year margin level. And that is without having to take any price increases as we intend for this financial year.
So to sum it up, Mr. Banerjee, just sort of a bigger picture question, and I take your point that, we need to have normalization of a couple of quarters, leave COVID behind, to get a very clear understanding of the growth rate the business can operate at. So while 10 to 11% might be the numbers we're looking at this year, I mean, what's the aspiration? Your margin profile at 27, 28%, probably investors will have no complaints there. But what will be the aspiration on growth? And in that context, what is going to be the rollout plan, the expansion plan in the West? I don't know if South is a big market you look at, because you already have a dominating position in the North.
Yeah, so we have a kind of, geography-wise, slightly different strategies. So North and East, which is our, core markets, there we are going quite deep in terms of our expansion. I think we've been talking about, going into tier 3, tier 4 kind of markets, and that is predominantly in North and East. And those are, that kind of is helping a bit in terms of, our presence, as well as our ability to reach a much higher number, of people. And it's a very populous geographies like, UP, Bihar, etc., where we are really going deep. So I think that's one part of it. West, we have done, Suburban acquisition. It's almost about, 2 years plus there. And that is the brand and on the platform on which we are riding. West is now contributing close to about 15% of the overall revenue. It's become quite sizable for us. And, the focus on that brand and that geography is going to be through maintaining the two brand strategy and a lot of focus on Suburban. South is also, an area we are now looking at, where we are, we stated this earlier, is we are open to looking at organic as well as inorganic play for South, because South currently contributes, single digits about, to our overall revenue, and we would definitely want to improve there.
Found anything interesting? So for the South, have you found anything interesting, and what's your appetite? What is the right size target that you would consider? And I mean, what's the thought process? Since you're clear on inorganic growth in the South, will you be using internal cash, size, and timelines?
So there isn't anything really definitive on the table right now which one can share. But we are obviously looking at opportunities, and we are really not looking at size profile as the key driver. I think it is more important on how and where we can get access,
Got it.
and obviously the quality of the asset, as well as the valuations, etc. That so this is an ongoing process. I think whenever we have something interesting to share, we will share that.
All right, Mr. Banerjee, we'll leave it there. Thank you very much for your time. Appreciate it. And thanks again for joining us. Now, there's 2 minutes to go for today's big blockbuster listing, right? PN Gadgil. And I think, it's going to be another big one because the indicative pre-open rate is about 70%, 73% higher in the pre-open. There you go. Those are pictures which are coming through. Ashish Kumar Chauhan, CEO MD at NSE, and I think the management team will come up and ring it in. So 354 on top of the issue price. It's expected to come to the market at about 834 rupees per share. So big one once again. Actually, it kind of segues neatly into this next discussion because 2024 has seen a total of 57 sort of completed IPOs so far. The number is similar numerically to 2023. But these same 57 IPOs have raised more money in the first 8.5 months of this year as compared to the whole of last year. Debashish Purohit is co-head in India Investment Banking, Bank of America, who's joining us now. Debashish, it's great to have you with us here. Good morning. Just a quick word on, it's getting bigger and bigger, isn't it? I mean, I think natural to expect it. The size of what's coming to the market is getting bigger, and I think the pipeline ahead is much bigger. Some of the bigger ones are all coming to the market soon. I mean, NTPC Green, there is Hyundai, there is, and there are so many others. So just wanted a quick sense from you, what's lined up ahead of us and what it bodes for the secondary market. Go on. Debashish, you'll have to unmute yourself, please.
Yeah, can you hear me now?
Yes, please. Go on.
Okay, yeah. No, I think you're right. I think this is consistent with the trend that we had picked up probably at the beginning of the year. And I think in a couple of other media interviews, I'd maintained that what we'll see in terms of capital raising and IPOs in 2024 is going to be a trailer for the subsequent 12 to 18 months. And we expected the second half of the year to rush in some of the larger IPOs. The first half, you had a volume of IPOs, but the sizes were pretty small. Just to put the data in context, we've had only 4 IPOs so far this year of sizes in excess of $500 million, and 3 out of those got priced in the last 3 or 4 weeks. So this is a sign of things to come as we go towards the end of the year, and as we turn the leaf into 2025. The IPO sizes are going to be bigger. In fact, I think 2025 potentially would be the biggest ever IPO year that we have seen in our lifetime.
Debashish, do you have a visibility on how many $500 million plus issues are lined up over the next whatever time frame you want to look at? And when you look at 25, you clearly have, because the pipeline is there and you can see it. What are we talking about? What numbers are we talking about?
Yeah, again, it's difficult to give a sense of the exact, quantum of the number of IPOs. If we were to aggregate everything together, a sense is probably over the next 12 to 18 months, we'll see an IPO pipeline of, maybe $25 billion plus.
Right. Debashish, quantitatively, while the numbers are large and the numbers of companies which are coming to the markets are large as well, we haven't really seen a frenzy when it comes to valuations. At least in a lot of the companies which are being offered right now, at least they're leaving some money on the table, and thereafter, post-listing, we're seeing a bit of a frenzy in these stocks. Do you think investors have become smarter and they demand better valuations from companies which are coming to IPO, or what phase of this frenzy are we in right now?
Yeah, I think that comes back to the way the IPO market is constructed versus to the listed traded comparable in the secondary market. I think IPOs is still a lot of hard work in terms of putting out your equity story with investors out there. And bulk of these activities are front-ended with institutional investors, right, with both foreign as well as domestic, who do their grounds of fundamental work on the equity story and then stamp out a valuation which they're comfortable with it. Whereas you take it to the secondary market post-listing, I think then the world kind of takes over with all this retail and high net worth and a participation, which takes it to a different level. So there's a bit of a dichotomy between the way you see the so-called frenzy in the secondary market and the way IPO pricing are constructed, which is why you see I think the pricing of the IPO is much more fundamental driven, largely led by institutional investors, and then kind of the secondary market takes over, which is a result of the unprecedented liquidity flow that we're in the middle of.
Debashish, hi, morning. So that's on the primary market side, but the secondary market itself has been so hectic, right? Investment bankers probably have had such a busy year. So many secondary sales where either promoters are selling a part of their equity or early stage investors are cashing out, PEs are checking out. Do you expect this activity to remain as hectic, as heightened as what we've seen so far in this calendar year? And also, what are the triggers at play? I mean, earlier when we asked this question to a lot of people in the market, I think the response is that PEs have their own compulsions. They need to go out and pay out their investors. But what's your sense? Is this the result of a huge amount of domestic liquidity? Will it continue to be as elevated?
No, I think there are two or three reasons, right? One is that if you look at the construct of or the cap table of the new IPO going companies, they are dramatically different than the variety that you saw, let's say, 5 to 10 years back, right? So the most of the, at least the newer age companies coming to the IPO market have a much more diversified cap table in terms of, multitude of investors who need an exit over a certain time frame even after listing, which means there's much more supply to come even in the aftermarket, which has been the case with, I think, most IPOs which has come to the market last 2 to 3 years. So that is reason number one. Reason number two, I think the liquidity profile of India market has transformed materially over the last 3 to 4 years, giving confidence to both pre-IPO investors as well as private equities and sponsors to monetize effectively without creating any market disturbance of the stock price. So that is reason number two. The liquidity profile is making people confident. And third is obviously, I think we have seen a wave of investments from the PEs, which is kind of maturing to an extent. I think people are looking at exiting some of those old positions before they rebuild their new positions. So I think these three factors together will continue to make the secondary block market reactive.
I think I just want to quickly make a mention of right on point, right? PN Gadgil, the listing is on your screen, and it's a super bumper listing, 70%. Well, there goes the Ganpati Bappa sort of,
well, they're from Pune, so it's only
absolutely festive mood there, right? And they sold stock at 480, and it's coming to the market at 800 plus. So as good as it gets. And as I think we were discussing earlier, it's not just on day one. In many of these cases, we've seen day 2, day 3, day 4. I mean, action continuing.
But just a word on the valuations. When they sought 480 rupees in terms of valuation, they were looking at around 6,500 crore in terms of market cap. Right now, it's closer to around 11,000 crores in market cap. Earlier, the trailing price to earnings was close to 42. So right now, that increases obviously to close to around 70, 73. But at 11,000 crore as well, the last time the management joined us, they said that FY27, their revenue targets are 10,000 crore on the top line with 10% margin. So assuming they do about 1,000 crore EBITDA in FY27, along with 500 crores in terms of net profit, at 11,000 crores market cap, it's still at around 22, 23 times 2-year forward earnings. And that is comparable with all the others. And when the IPO for PN Gadgil opened just before that, all the other gold stocks hadn't seen a bit of a rally. So in that interim period of the last 4 or 5 days itself, we've seen a massive surge in the likes of TBZ or Senco, all the other players as well. So all of that implies that there was expected up move in terms of this listing. And now at around
at a net level, Mangalam, 10,000 crore top line. At a net level, what kind of numbers?
So at an
EBITDA level, 1,000 crores.
So assuming 10,000 crore top line with double-digit margin, the base double-digit would be 10%. That's 1,000 crores. And, take out around 400 crores from depreciation, EBITDA and tax, etc. 500 crore roughly would 27. Be the net profit that you're looking at. 27. As compared to last year, where they did a net profit of close to around 150 crores. Obviously, a large part of that would be reduced because of the number of stores that they will add, and also, finance costs coming down with the debt repayment.
But roughly you're saying that all things put together, 22 times 2-year forward earnings.
2-year forward earnings.
2-year forward earnings. So let's see. I mean, the market maybe is willing to take that, at least at this point in time. Debashish, to get back up, and this is obviously on the primary market, and we've had another blockbuster listing just as we speak. But, my question, going back to that question, that was more for the secondary market. Forget the primary market for a second. Even in the listed space, there is so much hectic deal activity, right? Where promoters are either cashing out a little bit or PE guys are checking out. So more on the listed market space, will deal activity continue to be as robust as what we've seen so far?
Absolutely. This is exactly what I was saying. I think we do see that level of activity even in the secondary market to continue. And that is driven by the shifting nature of the cap table, right? Because, 10 years back, you had a largely promoter-owned entities coming to the IPO, and the maximum float which will come to the market is the bare minimum, which is 25%. Now the new generation companies coming to the IPO market are much more diversified in terms of pre-IPO cap table. You have multiple investors sitting over there who have a certain investment horizon, so they need to exit their positions over a certain period of time. So the free float, the effective free float which is coming to the market is significantly larger than the IPO class of, call it 2010 or 2012 or 15. So we will continue to see a significant amount of activity in the secondary market on a go-forward basis.
Cool. So just to take the point forward, how much of this activity that you're seeing, again, primary market, right, is in your estimation growth capital, and how much is it sort of exit by investors? So this year we've seen about 64,000 crores worth of IPO. Have you looked at the numbers? How much of it is going into building out businesses, setting up plants? How much is it just sort of existing investors getting out? And that $25 billion number which you put out over the next 12 to 18 months, I mean, same question. What would it be?
Yeah, I think if you go back in history, I think Indian IPO market have been largely secondary driven, right? I think the ratio could be anywhere between, call it 70 to 80 to 90% of IPOs coming to the market are secondary sale rather than primary sale. And even if you look at the next batch of large IPOs over the next 12 to 18 months, a large part of these would be secondary sale rather than primary proceeds. That's not going to change in my view.
Okay, you're saying that 70-80%, that high, I mean, essentially, is all secondary sales. And perhaps it will be in that ratio going forward as well.
That's right.
Just one last question. What are the hot sectors right now where you're seeing, where we should expect to see maximum deal activity going forward, Debashish?
I think it's pretty much everything, right? I don't think there is one particular sector.
There are no cold sectors. They're all hot.
Yeah. Well, you have the all-time favorites like consumer, financials. The technology is coming back in a big way, as we saw through Ola and first try listing, and the significant pipeline which is building up. Healthcare is pretty topical. I think the one sector which has stayed away or rather absent from the capital markets, which is infrastructure and renewable. That's because the deal activity in the private space is so robust. They haven't probably found the reason to come to the public market. And hopefully we see that change over the next 12 to 18 months. But save that, I think pretty much every other sector is in play.
New economy, people are saying because it's new economy, growth prospects, sunrise sector, etc. are doing extremely well. Old economy doing even better because they're saying it's not sunset yet for this sector because not anyone else is investing in these spaces right now. So maybe there is a longer runway than one was expecting. And middle of the road, obviously doing extremely well anyway. So,
to end things, Debashish, I'll go back to Mangalam's original question on valuation. So as all these hot sectors keep coming to the market, have the lessons been learned, and will it be very different from, say, 2021? I mean, we all remember the way Zomato IPO'd and a lot of the new age companies came in. So as we get the Swiggies of the world and maybe some of these newer businesses, even renewables, which right now you're saying is within the private domain, as and when they come to the street, what should investors expect on valuations?
And just to add to that, what could the next accident be? Because back in the day, we've learned lessons from those accidents. Now we've moved on. What should one be mindful of?
Again, it's like markets turn in a cycle, right? I think we saw a pretty long bull run, then we saw, some bit of a pause in 2022, and then the markets have come back in a pretty big way. It's very difficult to predict, what could be waiting for you in the next turn. Of course, I think valuations are extremely important to sustain this market. But I think what makes us comfortable and confident is that the exuberance that you see in terms of valuation in the secondary market has not translated compared to the IPO market. The IPO market is still very, very fundamental driven, bottoms of institutional investors driven, which is why you're seeing this divergence of what you get at the IPO at valuation versus what some of the stocks are trading in the aftermarket. I think so long as that discipline continues, that's good for the primary market, and this market is here to stay. It's difficult to say what's the next accident. I think we as market participants we are optimistic. And we look forward to the positive signs rather than worry about the potential accidents around the corner.
No one sees it coming ever. It happens when it happens, but it's going. The going is good. Thank you very much, Debashish. Appreciate you joining in and running us through your perspective on the sort of fundraise activity, which is robust, as Debashish has been pointing out. We'll take a quick commercial break here. We're going to come back in just a bit from now, and we'll put the focus on commodities. Manisha is here with us.
Welcome back. Well, let's straight away dive into commodities and figure out what the headlines are there. Manisha is here with the latest action. Manisha, over to you.
Thank you for that, Surbhi. Well, I'm looking at agriculture commodities. Well, everything in commodities actually is surging, whether it's about metals, precious metals, energy, and agriculture as a space. There are 2 or 3 themes which really seem to be working right now. One is the decline in US dollar index, which is back again below 101. The second is the US Fed meeting and this whole uncertainty about whether we are going to see a 25 basis or a 50 basis point rate cut. And that really seems to be keeping long positions intact for many of these commodities. The third thing, especially when you talk about the agriculture commodity, is the weather concerns, the higher freight charges after all that's happening in Red Sea. And that is keeping many of these commodity prices higher. I want to talk about Arabica coffee because that is trading at a 13-year highs. Brazil, which is the largest producer, has adverse weather conditions. And the Robusta prices also, by the way, seem to be increasing, and this is after the typhoon Yagi hitting Vietnam, which is again a major producer there. Well, after coffee comes cocoa, and here the prices are trading at a 2-week highs. The markets have seen the deficit continue for a fourth straight year in 2024. Also, there are supply concerns from West Africa, Ivory Coast, and that has been supportive. Talk about cotton, and while of course it's an industrial agriculture commodity, but we also have seen gains here to a 3-week highs. Well, the USDA has cut production for 2024-25 to 14.5 million bales. Also, the global output has been revised on the lower side. Consumption continues to be on the stronger side. It is a small crop this time around in US, Pakistan and India, and that has been supportive. Rubber continues to be an outperformer within this pack. It's trading at a 2021 highs, and Typhoon Yagi has impacted production here as well. And we are looking at lower production, by the way, in various producing countries like Thailand, Malaysia, etc. Sunflower prices gained 6% in the overnight market. So as I said, everywhere that you look, you are looking at stronger gains continuing. I'll get the final chart on your screen. Then this is the month-on-month agri-commodity price data. And as you can see, there are no losers there. It's all gainers, from soybean to wheat, palm oil, rubber, coffee, everything up between 2 to 10% onto this one. And that really continues when it comes to rice and sugar kind of commodities as well. You have 2 to 5% of gains on that too.
All commodities up over the last 1 month, and a big surge in prices of coffee and cocoa. Will be very interesting to see how the margins of companies like Nestle, etc., perform going forward. But speaking about these commodities itself, we take a short break. On the other side, we have Lata Venkatesh joining Sunil D'Souza, the MD and CEO at Tata Consumer Products, to talk about the consumer space at large, speak about commodity prices, and get in a word on their business as well.
Welcome back. India's recent growth story has been fueled by capital goods, not by consumption. Although the first quarter GDP did show a welcome 7.5% growth in private consumption, the July IIP number shows that consumption, especially of non-durables, FMCGs, is subpar. To get a handle on the consumption scene at a macro level and at a micro level, I have with me the Managing Director and CEO of Tata Consumer Products, or TCPL, Mr. Sunil D'Souza. TCPL itself, of course, posted a 16% revenue and a 22% EBITDA growth in their first quarter. Their international and unbranded divisions did very well, but tea and the recently acquired Nourishco brand of drinks had a subpar quarter. Mr. D'Souza, good morning, and thank you very much indeed for joining us.
My pleasure.
Well, let me start with the macro question that prompted me to invite you. We still see disturbing signs even in the July-August consumption numbers. Are these correct, or do you think that the consumer is still biting? Can you give us a picture of the rural and the urban consumption?
So overall, Lata, if you look at it, I think you heard a lot of commentary from the FMCG majors during the end of last quarter saying green shoots and people are bullish for a recovery. I would say I would still wait and watch because while the recovery will be there, I think it will be gradual. It will not be back to double-digit growths of the past very quickly, and for a couple of reasons. I think the recent weather phenomena impacting rural with drought in May, June, and then excess rainfall.
Yeah.
I think that's part number one. Part number two is overall, while you look at inflation, if you disaggregate it, I think food inflation is significantly higher.
Yes.
So from that perspective, I think there is still a little bit of pressure, which I would think when the crop season comes out, we should start seeing it easing off a bit. That's number one. Number two, there is a trend, however, that rural was significantly lagging urban. I think rural is starting to catch up with urban right now. So from that perspective, it looks good. But double-digit growth, I would say, some time to come.
Okay. In terms of volumes, how have you done? Your second quarter is almost up. We have only about 2 weeks to go. So did volumes look better than Q1?
I would say volumes broadly in the same ballpark as Q1, not a significant difference.
Okay.
But that said, we are starting to see various fluctuating effects of commodity prices.
Oh.
Tea, for example, I mean, because there was drought in the north and then excessive rainfall, tea prices in the north are about 25% off. So that will start moving into the consumer domain as inventories run down. Right? There was a bit of excess rainfall in Gujarat and brine has shot up. So that means salt prices should be slightly higher. Coffee, I'm sure, is I would say the latest gold from a commodities. This thing hitting, I think Robusta hit about $4,500, which is more than 2x what it was 1 year back. So commodities complete topsy-turvy ride. I think that is the one piece to watch out for.
Okay, no, that's very useful information. Let me start with the most premium of items. Is the premiumization trend still intact? Premium products do well. It's the mass products that get hit by, inflation and drought. Is that a fair assumption?
I would broadly agree with you, and that's exactly what we're seeing in our portfolio as well. So while overall we talked about tea being under a little bit of pressure, the premium and the mass premium continues to do well. It's the lower segments which are under pressure.
Okay.
2/3 of my portfolio is now premium to mass premium, which is quite okay. In salt, value-added salt is growing at high double-digit versus base salt, which is still chugging along at single digits. So overall, that trend, I think, you will see for some time.
Okay. Just a word on the overall numbers. You did revenues, 16% in first quarter and 22% EBITDA. Repeatable?
Again, if I break it up, Lata, out of the 16%, base was 10.
Okay.
And the balance was due to acquisitions.
Yes.
I would say will be broadly in the ballpark.
Okay. Okay. What are the strengths? Which has Narishco re-emerged after a quiet summer beaten by the terrible summer? Likewise, tea. Within these, are you seeing any improvement? Those were the ones that didn't do well in the first quarter.
I would say for tea, broadly, the trend remains constant. Volume growth, I don't think we're seeing it coming up back rapidly while we are holding market share more or less. There is a bit of stress on the category overall. That's number one. Number two, to answer your question on Narishco, it was a couple of things. One was the high temperatures because of which we didn't see out-of-home consumption, and our Narishco business, especially with the cups, Tata Gluco Plus, etc., is primarily out-of-home. So that was number one. Number two, there is increased competitive intensity in the beverages space with the entry of other players. And I think we were slightly late to the party in terms of correcting our pricing and go-to-market.
Okay.
So I would say we're probably still one quarter off to see the Narishco growth coming back totally. But broadly, directionally, month on month, we are seeing an improvement.
Okay.
The other big priority for us as a company is to make sure that we bolt on Capital Foods and Organic India are two acquisitions. Last quarter, Capital Foods grew 9, Organic India was -2. Directionally, we're in the right ballpark. We finished the integrations. Now the engines of distribution, innovation, marketing, as they start firing, and we are seeing growth trend in the right direction.
Okay. I'll take your point that some of the trends of Q1 are continuing in Q2. But for the full year, as you said, as the harvest hits in terms of money at the hands of the consumer, will second half be much better? I mean, better than your 15.3% margins, your 22% EBITDA, will both be better?
So overall, Lata, I do expect to be on a significantly better trend in the second half versus the first half for a couple of reasons. A is, our entire distribution expansion of expanding width in the rural areas and including depth in the outlets by adding a third salesman in the big urban areas, splitting the portfolio. That would have played out completely.
Okay.
Number two, my digitization of my front end, and we're moving to a Salesforce-based digital analytical platform where I can sharpshoot very well outlet by outlet. I think that comes into play. Number three, my acquisitions integration is done. Now the innovation engine has started firing, marketing starts to fire.
Okay.
Number four, overall macros, I do expect to be better. And especially if I look at last year, second half, I think we are cycling relatively softer numbers.
Okay.
So from that perspective, we remain confident of a good full year.
Okay. Oh, that's good to hear. Salt and Sampann fired well for you in the first quarter. Will salt be a big problem now because of those excessive rains in Gujarat?
Not exactly, Lata, because if you look at over the last 4 years, from the time we formed Tata Consumer, our salt market share has moved from 30 to 39.
Okay.
In that space, we've seen rapid inflation, and where earlier it used to be a 1 rupee per year price increase, I think in FY23, if I'm not mistaken, we took roughly 5 or 6 rupees at one shot because of all the petroleum-led and brine-led cost increases, but we still delivered market share and growth. Okay. So we will take it in our stride. We will figure out how to balance margins and growth to make sure that we continue to drive this engine. We've always maintained salt mid-single digit volume plus a couple of bips of price mix. I don't think we're changing the forecast there. Sampann last quarter plus 37. There's no reason, and we've always guided for a 30 plus. I think we remain confident of that number.
We don't see an ad blitz from you on these products, especially Sampann, which became a household name during COVID when people shifted from unbranded to branded. What's your ad expense? Will you up it?
So last quarter for the India business, our ad expense was roughly 7.8% A&P, which was significantly higher than last year. As a company overall for the last quarter, our A&P was about 29% higher than the same quarter last year. So historically, we've been underspending, and directionally, we've been raising our A&P growths. But just a perspective that, especially when you talk of Sampann is basic staples.
Yes.
It's not high personal products which make 70-80% gross margins and therefore have affordability. I make barely double-digit margins, and therefore I need to be very, very mindful about where I'm going to put my investments.
Okay. No, that's a fair point. Since I'm a consumer, I know what Sampann provides. Which do you see as the growth engines? For instance, Ching's. Will it be Ching's? Will it be Organic India? Which will be the high margin products?
So let me answer it in a couple of ways. Our basic platforms have been tea and salt. And tea and salt, we've always guided for mid-single digit volume plus couple of bips of this thing. And then the rest of the growth businesses earlier used to contribute to 20% of our portfolio, and we had guided for a 30% growth. We are now saying they will contribute to 30% of our portfolio and grow at 30%. So Nourishco, Soulful, Sampann, and now Ching's and Organic India, all of them put together will deliver a 30% growth. In terms of margins, while Sampann is slightly lower than my category average, but higher growth rates, Nourishco is broadly at par with my category, my overall company margins. Soulful is slightly higher. Ching's and Organic India, one of the primary reasons why we did these acquisitions were because we saw growth potentials for significantly accretive margin categories. So those are high margin businesses.
Okay. Okay. 15.3 was what you delivered. Full year, will it be more?
Let me say we'll be in the ballpark.
Okay. Well, just a word on your distribution. You had added 1,300 distributors in FY24, primarily in urban markets. The strategy for 25 is?
So the strategy for 25 is to stabilize the 50,000 plus population town distributors which were added. That was number one. And number two, in all million plus, which is the 10 lakh plus population centers, and a few 5 lakh plus population centers in the south where there is high affordability, we have split our front-end salesmen into three different pieces. There are 3 people going in. tea plus Organic India, salt plus Sampann, and Capital Foods plus Soulful, which then gives me depth in the outlet. 3 different people going with focus, with, not getting distracted by the whole wide range of the portfolio. I do think outlet by outlet will start gaining market share.
Okay, finally, you were the acquisitions man. We saw a string of acquisitions after you came in. Anything on the table? Anything we should hear in FY25?
See, longer term, we always maintain we will grow organically and inorganically. But I think in the shorter term, immediate shorter term, I would say, we've got to deliver the business case for Capital Foods and Organic India, which then gives us the right to go back and ask for more investments. But first, I have heads down, execute against our business case and deliver the numbers.
Okay, all the very best. It was a pleasure speaking with you, Mr. D'Souza. Thank you for spending time with us.
Thank you. My pleasure. Always.
Okay, so that's a bit of a caution in the second quarter itself, but very confident of the second half of the year. That's the word from Tata Consumer. We're going to a break and thereafter, Chartbusters.
City gas distributors, Mahanagar Gas, IGL both surged more than 4.5% after UBS issues a bullish note on the stocks. Now they're sitting with gains of almost 6% for Mahanagar Gas. UBS has upgraded IGL to buy from sell and raised the target price to 700 rupees. Also raised the target on MGL from 1600 to 2400, citing an improvement in volumes.
Ola Electric zooms 4% after a slew of brokerage notes. BofA Securities and Goldman Sachs initiate coverage on the stock with a buy rating, citing multiple growth triggers.
Bajaj Housing Finance continues to rally for day 2 After a big doubling from its issue price yesterday, the stock is up 8% today.
Torrent Power climbs more than 3% after the company enters an MOU with the government of Gujarat for the execution of a solar wind hybrid project.
And from one big listing yesterday to another big listing today, P.N. Gadgil Jewellers sees a strong listing on the bourses, listed at a premium of 73% at 830 rupees versus an issue price of 480 rupees, still holding above that 800 mark with a gain of 67% versus its issue price. You don't go anywhere. The management of P.N. Gadgil will join us shortly on our show to discuss the company's post-listing strategies. Good morning. You're watching us here on Chartbusters. I'm Mangalam Malu. Joining me today is Vivek Iyer. In case you've hit the snooze button for a while, woke up late, you haven't missed anything. As you can see at the top of our screens, the Sensex, the Nifty, absolutely flat, as is the Nifty Bank, mildly in the green, is the mid-cap index, which is actually under a little bit of pressure, down 0.4% as we speak. And as we speak, we have the broader markets, the breadth of the market, firmly in favor of declines than the number of stocks which are advancing. The number of stocks which are declining are actually twice the number of stocks which are advancing. So the crisscross lines come up for you, tell you that earlier it was firmly in favor of the green lines, thereafter there was a bit of an intersection, and now those lines far apart with the red one much above. Hi Vivek.
Good morning, and like you mentioned,